Hey, Charlie, I'm just going to flip the script just a little bit because we were talking about bonds and, we start talking about the Feds raising rates and how that affects the market. And the question we get a lot is, so the Fed's raising rates because the economy is supposed to be strong enough to stand on its own. And then the market seems to go upside down there a little bit. What gives? Well, Apollo, can you shed some
Yes.
light for our listeners?
Yeah. So let's start with exactly that. So you hear so much on the news today about the Fed raising rates. What's going on with that? To understand that, we have to go back to the 1970s. And what happened in the 1970s is a bunch of things. And one of the big ones, in my view, was the fact that the US, up until 1971, had something called the gold standard, meaning that if you wanted to print a dollar, if the government wanted to print a dollar, there had to be some gold in the bank. So you can always go and exchange a dollar for a certain amount of gold. And that gave people comfort that the government is not just going to print money willy-nilly. Now, in 1971, the economists and everybody realized that you can't have the system because the economy is getting bigger and bigger and bigger, and we just don't have enough gold to create all the currency that we need. So in 1971, President Nixon actually cut that link between gold and the dollar. And since 1971, we have a type of money called fiat money, which basically has value because we all believe that it has value. And that, I'm trying to go back in a time machine and see how would I have felt as a citizen of the country if I'm being told that right now the government can just turn on printing presses and there's no reason for them to stop because there's no backstop. They don't need gold. They just print as much money as they want. So there was a bit of a behavioral element that came into the society when we made that transition. And just around the time, also the Organization of Petroleum Exporting Countries, they got really upset because of our policies in the Middle East. We're not involved directly, but just to show their displeasures with our policy, these particularly OPEC countries in the Middle East, they chose not to send oil to the U.S., and we went through a big oil crisis. So when you combine these three, and there was a big food shortage because of a drought, what happened in the early 70s is that we had a really big inflation, really high inflation relative to historical standards. And that inflation reached, 10, 11% back in the early 70s. And people got used to the idea of inflation being around. And they, when they negotiated contracts, the union negotiated contracts, well, they would bake in a pretty big increase from year to year because they thought that inflation is resilient and is here with us to stay. And in fact, it did last all the way into the late 70s and early 80s because of that behavioral element, because that people did not believe that the Federal Reserve is really committed to fighting inflation, and they were not. And in 1979 or so, a new chairman came at the Federal Reserve. His name was Paul Volcker, and he actually really kind of made the very strong decisions that we need to fight inflation, whatever it takes. So he started to raise interest rates. And the idea is that when you raise interest rates, it becomes more expensive for companies to buy things and they don't produce as much. The housing market might take a hit. Borrowers are finding that it's more expensive to borrow and they don't borrow as much, us as consumers. So what it does, it starts to slow down the economy because purchases are being reduced by consumers, by businesses. And because of that, there's not as much pressure on production in the US, and that starts to slow down inflation. So the reason that you're hearing so much about the Fed today is a lesson that we learned back in the 70s, that the Fed has to be really committed to fighting inflation. And the way that you fight inflation is by increasing interest rates, which makes companies and consumers less likely to spend money. And when that happens, then you start reducing inflation. Inflation start getting under control. That's exactly what happened in the early 80s. And a lot of folks were concerned because if you do this, when you do this, if the economy slows down enough, well, we might run into the other issue, which is a recession, that we might not have enough production out there because people are not buying enough or businesses aren't buying enough. So that's where the concern comes from, is the fact that the Fed today has been very clear that they're committed to fighting inflation the same way that the Fed was in the late 70s, early 80s. which again, it proved to be a very good decision. A little pain in the short run, quite a bit of pain actually in the short run, but eventually it was tremendously beneficial because ever since then, behavioral people knew that Fed is committed. So we're not going to really worry that much about inflation because Fed is committed to keeping it low. And that's what the Fed is trying to do today, is really trying to raise the rates, slow down purchases, and keep inflation under control. And it's trying to do it in a way that's called soft landing, meaning that the economy might not produce as much, but it won't enter a recession. The question for an investor, so with that background, the question for an investor is, well, what does it mean to the stock market when the Fed is raising the interest rate? And to do that, just to kind of clarify one thing, when we're talking about the Fed raising interest rates, in fact, the Fed only controls one interest rate, a single interest rate. They don't control mortgage rate. They control a sort of a baseline interest rate called the federal funds rate. That's the one that they can impact directly. So we can look at that particular interest rate going back, let's say, this century, and try to see if there are any lessons or case studies that we can examine. So if you go back to 2000, what you see is that the beginning of the century, around 2000, the federal fund rate was very high. It was, around 7% or 6.5%, 7%, so quite high. And then as we got into the tech bust and we had the attacks in 9/11, it basically started going down and down and down. And around in 2004, it started to go up again. So here is a case where you have 3 years between 2004 and 2006 of back-to-back years in which the Fed increased this interest rate. At the time, it was to cool off the economy so we don't run into inflation. But now you have a good case study. Look, we have 3 years when the interest rate was on the rise. So we can examine that. And then what you see afterwards is that when we had the financial crisis, the interest rates went down. And in fact, they went down incredibly low, close to zero for many, many, many years. And they stayed low, pretty much like the same way we are today. But what happened, what we were up until about a few months ago. And then we have another 3-year period between 2016 and 2018, when once again, there's a period of rising rates. Over 3 years, back to back to back, we see this increase in interest rates. So to me, it's a very interesting question now. So we have 2 case studies to look at as investors and try to figure out, how does the stock market react to these increases in interest rate, which is likely what we're going to see this time around, maybe more than a quarter or two of increases in rates. What is the market's reaction to that? So let's take the first period, the 04 to 06, and look at year by year how the S&P 500, the measure of the US market, did. In 2004, as the Fed was starting to raise the rates, the S&P was actually up 10.9%. In 2005, it was up about 4.9%. And in 06, 15.8. So even though we had 3 years of back-to-back increases in the Fed fund rate, in every single year, the market went up. So, when you look at this, it's kind of hard to make a case that, increase in interest rates should necessarily be bad for the market, because that's kind of what the conventional wisdom is. It becomes more expensive for companies to borrow. They had a very low cost of capital. Now it's going to go up. That's not going to be good for the market. That's not what the data shows. Now, what about the second period when you go to 16 to 18? 2016, the market's up about 12%. And just to put some context, long-term average is about 10%. So this was above long-term average. In 2017, 21.8% as the rates were going up. And in 2018, down 4.4%. So we do have a negative year here. But ultimately, when you look at this data, I'm hard pressed to find the evidence that suggests that conventional wisdom in the media, that rates are going up, it's going to be terrible for the stock market. What the data is suggesting is that if you look at the 2 case studies over the past 20 plus years, there was a year when the market did drop, but 5 out of the 6 years, the market did not drop. So why might that be the case? How do you think about this? What's the intuition behind it? And to me, the big thing is this: when you look at the stock market is about getting ownership in companies. And the value of the ownership depends on the profits that the company expects to make. And we'll come back to this because it's a crucial concept. And if you think in terms of the value of a company being of Apple, Google, Facebook, you name it, Coca-Cola being tied to the profits that they make, the question is the federal funds rate a primary variable that you can link directly, that the profits are tied directly into what that interest rate does. And what this data seems to suggest is that, there's probably, it's actually quite likely that the Fed fund rate does have some impact on the profits of a company, but it doesn't seem to be a primary connection there that you say, okay, I can, link and say, if interest rates go up, profits go down. Not necessarily. In fact, what it shows is that it's probably one of the many, many, many variables that impacts the market, but it doesn't appear to be one that you can directly link. So because of that, when this Fed fund rate happens, keep in mind that the markets know about this. The Fed's been telling the markets, and because the markets are so sophisticated, they already incorporated the expectations of increases in rates. But even if you look at times when you have back-to-back-to-back years of increase in rate, it does not necessarily spell doom and gloom for the market.